Welcome back to the Baird Retirement Management Show. Today we're joined again by Greg Ashcroft and Scott Bartosh. Today you can expect to learn charitable distribution strategies, how to maximize your tax deductions with charitable giving, and qualified charitable distributions. Scott, where should we begin?
Yeah, I think the first place I would start is, why are we doing this, to be really honest with you? Because it's really easy as a financial advisor or talking to your financial advisor to just kind of jump into all these slick charitable gifting strategies. But the first thing that you need to think about is, what is the purpose of giving this money? Does this organization that I want to give that I'm giving money to, is it aligned with my values? Is it important to me? Because I think in our industry, it's really easy to kind of almost guilt people into charitable giving because of these kind of perceived tax benefits that are out there. And they're there.
Oh, yeah.
Go ahead.
Well, I mean, and that's a good point, because you're right. When you talk to a financial professional, or I suppose the stereotypical conversation with a financial professional regarding charitable giving, it's kind of like, hey, I'm looking for some strategies that might mitigate my taxes this year, and that could be for any reason. And the financial advisor comes to you and says, well, have you considered giving some of your money away? And you think, well, okay, but this is kind of a very personal, I feel like donating money is far more personal than that. And I think just tying it to a tax situation without regard to what the organization is doing, whether or not this person has been charitable up to this point in their life, if they're just doing charitable giving, but not in a way that will maximize the tax benefits. I think if you have a conversation totally bereft of the more personal side of giving, it can feel very sterile.
Yeah. And I guess what I'm just saying is, if you don't have a cause, or if there's not a cause of action, so to speak, on this idea, then 60% of your money you can keep if you just expose it to said taxes that we're talking about mitigating. So I think that's really where I start in this conversation, is make sure you have a plan, make sure that this is important to you, and then let's have a conversation. Yeah, whatever it is, if it's a hospital, if it's the university you went to, if it is a homeless shelter, it could be anything, but let's make sure it's important to you.
Yeah.
And then let's go from there.
Yeah. And I think that, and we've referenced this on previous podcasts, when you work as a financial planner, when you work with a financial planner, you quickly discover that taxes are perhaps the most malignant element of planning, which means they invade every decision we make with respect to someone's money is going to have a tax consideration attached to it. And I think with charitable giving, the sterility of tax planning does not fit well with a person's desire to say, give some money to a church, give some money to a charity. These are very often deeply held personal convictions that a person wants to maintain separate from a perceived tax benefit.
Yes.
And then the other element of that is, a lot of times when we're talking about gifting strategies, people immediately assume, oh, this is giving to some sort of opaque 501c3 organization where I'm not real clear on exactly where the money is being spent, where it's going. But some of the things that we're going to talk about today will include estate tax planning, which can mean gifting assets, not necessarily to a charity, but to children, because that will reduce, estate taxes. And that's one way we can still get a tax benefit, but perhaps make the giving more purposeful.
So I think that's a good segue to the first way that you can give money to a charity. Say this is your, again, church, university, it could be anything, just giving some cash. And that is probably one of the easiest ways to do it. You can use after-tax funds from your paycheck, give money to said church, and you will get a tax deduction on those funds that you've donated.
Yeah, I think cash gifts to public charities could be called the plain vanilla way of donating money. And the cash gifts, because there's not, and we're going to get into some more esoteric strategies later, but the cash gifts do provide you can deduct the most in terms of what percentage of your AGI. It's 60%. It's the highest one. That's a cash gift to a public charity. And like I said, this is the most straightforward way to administer a donation.
Yeah. And so from the very beginning, just to give everybody some context, I would say that when you're looking at charitable as a part of itemizing, which this is an important distinction, where tax changes from several years ago have made it to where it's actually a lot tougher to itemize. So if you're giving a few $100s to a charity, you probably are still going to take the standard deduction.
Yeah.
You're going to have to look at your entire tax situation to see, all right, what is my mortgage interest? What are my property taxes? What is my charitable? And it's going to need to be in excess of, $25,000. I don't have the exact threshold where we are right now.
I mean, the thing, you're right. With itemizing deductions as it stands today, you either have to have a whole lot of mortgage interest, you have to have, and your state and local taxes are capped at $10,000. And so even if you're taking the full weight of that, if you don't have any mortgage interest, you need to give away about $20,000 to a charity of your choice just to get you over the threshold of not taking the standard deduction if you're married.
Yeah. So that's a starting point. Just wanted to get that out there. Another way that, so say you're looking into charitable giving and you don't want to give cash. You have some stock in a brokerage account, as an example. That can be another attractive way to gift. And one of the things that is nice about gifting appreciated property is that, say you bought, a share of Apple 20 years ago, and it's, gone up 20x over that time frame. If you give that share to charity, you don't pay tax on it, and the charity doesn't. Now, you are capped on the amount which you're able to deduct from your income, 30% of your AGI. But, except if you have a very specific strategy to maximize charitable giving, you're probably not going to be pushing up on 30% of your AGI. So gifting highly appreciated property, if you don't want to pay the capital gains, that can be a nice way to start.
Oh, for sure. Yeah. And as you mentioned, the charity doesn't pay any tax on that highly appreciated security. It's a really great way to whittle down some highly concentrated positions in a portfolio in a very tax efficient way. Now, clearly, you don't stand to benefit directly from that appreciation on the security. You've made some money off of it, but you're perfectly happy to part ways with that money, and it will provide perhaps a tax deduction against some other sources of income that you might have. So there can be some portfolio management strategies that are considerations for donating highly appreciated assets. There's a lot of different uses there. And I think one of the things we would want to touch on with highly appreciated securities when it comes to intergenerational giving, rather than just explicitly charitable giving, is the tax code views capital gains differently than it views ordinary income.
Yes.
And so if you have a person in your family who is either younger, maybe a college student or fresh out of college, who isn't going to have much in the way of taxable income, you can gift them highly appreciated securities. They can sell them, and they can pay probably a lower capital gains rate than a person who has owned these highly appreciated securities would pay if they had, other sources of income that were more than this college student.
Yeah, that's a tax arbitrage opportunity, so to speak. I think the caveat there is you just have to be very comfortable that once you make that gift, it's going to go to the thing you want it to go to.
Yeah. So and there's no immediate upfront tax benefit.
Yeah, you're not getting any benefit, and you're losing control.
Yeah.
So say you give it to them, they sell it and spend it on a speedboat. That's not what you were looking for.
Yeah.
Could be a problem.
And there's other considerations that this is a gift, and it could be in excess of the annual exclusion. So you'd be using some of your exemption. I mean, there's a lot of things you would want to go through. But I think the point of bringing that up was we don't just have to be considering strategies for gifting directly to charity. There are some reasons why you might want to pass highly appreciated securities either off to a 501c3 or just down the generational line that could have some lesser known tax benefits.
Yeah. So there's multiple reasons to do this. It's not all tax deductions.
Yeah. And
it's not all
right
pure charity.
Yeah.
Some of it's familial charity, so to speak.
And I think, and just pausing to consider this here, because a lot of people do make this error, you would never donate depreciated assets.
Yes.
You would just sell the asset, take the loss on your own taxes, and then you could donate the cash, thus getting that deduction, as opposed to never. Well, I shouldn't say never, because, never's an ultimatum, but it would be very rare for a person to ever want to donate or gift depreciated assets.
I guess you could if you were certain that it was going up in value within the next 30
Right,
days
yeah.
within the wash sale rule, but now we're really in the weeds.
Now we're very much in the weeds.
Yeah. So I think that's a good transition point. One of the most common ways that we see people use their, donate to charity is through their IRAs. And there is a provision in the current tax code that allows you to, once you have reached age 70 and a half, infinite wisdom of the government there for the half year. Once you get to age 70 and a half, you are eligible to make donations directly from your IRA. They are not deductible, so they do not help you to get towards that itemization threshold we talked about a little bit earlier, but they don't count towards your income. And then once you hit required minimum distributions at age 73 or 75, depending on your age, they will reduce that R&D or required amount you have to take from the IRA dollar for dollar.
Oh, yeah. And qualified charitable distributions are perhaps the most powerful giving tool that a person with highly appreciated assets in their qualified accounts could use. And particularly if they are already charitable, becoming suddenly charitable at required minimum distribution age, it's a strategy, but it's just less common. But a person who's already donating a lot of money, and for people with personal convictions, a lot of people tithe a fair amount of their income to their church or what have you, they're already going to be giving this money away. And so when they come to a financial advisor and ask them what is the most efficient way of giving this money away, for a lot of people who are 70 and a half, who have very large traditional IRA balances, where if we can pull some money out of that account for spending that this person already intends on doing in an entirely tax-free way, that is a beautiful, beautiful strategy that they can employ.
Yes. And the other thing to think about there is, again, going back to the itemization threshold, say you're 70, maybe you don't have any mortgage interest anymore. You've paid off your mortgage. And so all you have other than charitable to push you into itemization is property tax. So even if that's maxed out, the first, say, $15,000 to $17,000 of charitable does not help you from a tax perspective.
Oh, yeah.
So at that stage, it really behooves you to port over or switch over to QCDs instead of after-tax money being a gifting source.
And then I think that a mistake a lot of people make is they go right through age 70 and a half. And this is a more common mistake now when they've disentangled because you used to start mandatory distributions at 70 and a half.
Yes.
And then they moved it to 72 and now 73 and then 75 for some people. So it's very confusing. But they left QCD back at 70 and a half. And so I think for a lot of people who have very large IRA balances and not following Scott Bartosh's wisdom of building up very large assets in their after-tax accounts, they are actually distributing money from the IRA only to then go ahead and give that away. So they're taking some cash out, and then as part of their monthly or quarterly budget, they're donating some of that cash to a charity. And for some of those people, they're not meeting the itemization threshold. So if you can imagine what's just gone on there is they've paid ordinary income taxes on an IRA distribution. They've given a part of that IRA distribution to a charity, and they've received no tax benefit for having done so. And so we can come in and say, well, hang on, why would you go ahead and distribute $10,000 a month if you're going to plan on giving away $1,000? Let's just do a QCD, and that way, that never even hits your AGI. And that can have other downstream effects, by the way, which is a lower AGI can, if you're on the threshold, and very few people are, Social Security benefit taxation could go down.
Medicare
Part B premiums could go down because these are not hitting your AGI. And then if you need some other deductions, so say you incur some medical expenses, if your AGI is lower, that threshold of deductibility for some of those things is also lower, just because it's a smaller, it's the same proportion, but on a smaller number. So there are a lot of reasons why you would want to give directly from your IRA, even if you had some after-tax liquidity that you could come from.
Yeah. So I would say, as a starting point, as you are pushing towards your late 60s, if you have substantial money in an IRA, seriously consider having a conversation with us or your financial advisor about what is the most appropriate way for me to transition towards QCD versus the way I'm giving now.
Yeah. Another common strategy, and this is really going to tie back into the cash or highly appreciated security strategies that we had talked about just previously, is the use of a donor advised fund.
Yes.
And I think that donor advised fund have this sort of veneer of complexity to them, which might make them somewhat intimidating for people to employ, or they might be seen as something only people who have hundreds of millions of dollars use, kind of like a family foundation. But that's not really right. I mean, you can use a donor advised fund even for people of modest means.
You can. I think the biggest factor in setting up a donor advised fund is you need to make sure that you have enough of a gift to where you want to spread it over multiple years.
Right.
Because there is an administrative fee component to having a donor advised fund. So what you're really attempting to do, and this is another bullet point I'm going to kind of bring in now,
that's a good idea.
is there's a concept of bunching charitable contributions. The idea is, let's say I want to give $10,000 annually to organization X each year for the next 7 years. Instead of doing that, say $10,000 per year over that 7-year time frame, I give $70,000 to a donor advised fund, and I get the entire tax benefit or deduction for doing that in year 1. Then for the next years 2 through 7, the charity is still getting their money. So if, say, you did a capital campaign or a structured gift, something like that, the charity is still getting their $10,000 every year, but you can just take the standard deduction, while the donor advised fund is the one that is actually dispensing the money each year.
And I think that's a really important point, because there are some situations that people fall into, particularly right at initiation of retirement, where they're going to have to accelerate the recognition of some income that they had been deferring over the course of their career. Or they might have something that is common among some of the people we work with, which is a big net unrealized appreciation distribution, perhaps a non-qualified pension piece, and maybe some restricted stock. There are a lot of reasons why you will lose a little bit of tax control over your income when you enter retirement. So this charitable bunching strategy says, all right, I have an unusual amount of income this year against which I want to maximize my deduction.
Yes.
If you're already a charitable person, you might be thinking, well, I know I'm going to be making gifts 3, 4, 5, 6, 7 years in the future. Could I accelerate those gifts till today, take that bigger deduction against some of this very unusually high income, and then just proceed to take the standard deduction in the years that follow? And that is a strategy that you absolutely should employ.
Well, in that case that you're talking about, that the money that you're getting the deduction on is, say you had a non-qualified pension, like you said, you're very likely in the 35 or 37% tax rate if you had that kind of a benefit at retirement. So that $70,000 in the scenario I put out there, it's 35 and 37% tax income, versus if you did it the next year, maybe you only have $150,000 of income. At absolute best, that's 22% tax type income, and you've got the bogey of the itemization threshold.
Yeah,
that's pretty high. So that is something that makes a lot of sense.
And I think one of the real keys for donor advised fund too is, though it is your donor advised fund that is going to be doing the gifting in the subsequent years, a lot of people have some closely held personal convictions, like a tithe, where they come to us and say, well, I can't just accelerate all my tithing into 1 year and then not give anything to my church for 4 or 5 years, which some people might do if they've got cash on hand to make a big cash gift in 1 year rather than using the donor advised fund. And the beauty of the donor advised fund is the charity is still receiving money that is tied to you, so that your name is still associated with those charitable gifts in those subsequent years after you funded your donor advised fund and received that bigger tax deduction for having done so. So your church, your charity of choice, your alma mater, whatever the case might be, they're still going to know that you're donating money to them. It's just coming out of the donor advised fund with no associated tax benefit in those subsequent years. But I don't want people to think that they're putting this money into a black box. This organization's going to take it over and dole it out. No. You're still going to get credit for these gifts. It's just done so in a more efficient way.
And also, it's important to note, especially if you're giving, say, an asset or security that has gone up in price, once it's in a donor advised fund, depending on the structure you use, you could keep it in that asset. So say you put $70,000 of stock into a donor advised fund, and then it goes up to $100,000, that the charity would get the benefit for that.
Yeah.
So, I mean, you're not going to, which, I mean, I guess you would just have more taxes to pay if you left it on the outside. But just going to the donor advised fund doesn't mean it's just cash or it's a dollar amount that has to be depleted. It can stay invested.
Yeah, and you get to select when the money's in the donor advised fund, you get to select the charities to whom these, they call them grants, will ultimately be made. You do retain you do retain a bit of control over the assets that are in that donor advised fund. You don't, obviously you can't benefit from them, but you do retain, I believe, buy and sell decisions within the donor advised fund. So it's a really neat way to be charitable on an ongoing basis while you have a high need in one specific year, or an unusually high need in one specific year for tax deductions.
Yeah, and so I want to touch just a little bit more on that NUA, or net unrealized appreciation item, because some of our listeners are likely working with companies where you own stock in your 401k or your savings plan, and it has gone up a lot over the course of your career. One of the ways that you can kind of marry, so to speak, donor advised fund and an NUA distribution is, at retirement, you could look at, all right, how much would I want to give to charity over the course of several years? And if you need to, you can actually generate income, which is then used to offset with the charitable deduction. So it's kind of, you can almost create the income to then have a larger amount to deduct. So say, as an example, that $70,000 that I've been talking about for a little while now, if you only have $150,000 of income in that year, and you want to give $70,000 of appreciated stock, you're beyond the threshold. You're beyond 30% of your AGI, so you're not going to get credit for all of that. You could do that NUA distribution, generate some more income, so that when you give those shares, you're able to take the whole deduction in year one.
Mm-hmm. Yeah, I mean, this notion of the creation of income, I think like these are some abstract topics, but that's why if you're considering doing a donor advised fund, if you're considering qualified charitable distributions, if you don't know if you should give highly appreciated stock or just a cash gift to a charity, there are a lot of variables that you're going to have to examine in order to make the best gift. And that's why I think working with an advisor, working with a person who is knowledgeable on the topic makes a lot of sense for people. And but at the same time, we don't want to feel like people can't approach us with these questions because they don't have the asset base, or they don't have their plan isn't sufficiently complex. It's like, no, whatever it is that you might want to accomplish from the charitable side, it's definitely worth the conversation. Definitely worth the conversation.
Yeah, I agree. So let's move to talking a little bit about charitable strategies that are a little bit less focused on deductions and more focused on estate tax. Now, one of the things we talked about in a couple of podcasts is the estate tax thresholds right now are very high. Mm-hmm. So unless something changes, there's just not that many people that estate tax applies to. Just, we're talking about people with 24, 25 plus $1 million. So very high threshold. We'll put that out ahead of time. But a couple of things that you could think about if, say, you wanted to move some assets out of your estate tax qualified estate, charitable remainder trusts and charitable lead trusts. Greg, do you want to take a crack at either of those?
Yeah, and I would kind of following along with you there, definitely give the on this intro that charitable remainder trust, charitable lead trust. These are more esoteric estate planning strategies where the use of an estate planning attorney or estate planning team would be highly beneficial. And these are going to be, probably for very large estates. So we're talking about ultra high net worth people who they want to have some money that leaves their estate, not going to be taxable at their death or at the death of their spouse, but and they have a charity in mind that they want to have benefit. And so the charitable remainder trust, charitable lead trust, those are essentially two trusts of the same flavor. One is going to leave assets to, or one is going to produce an income stream for the charity of choice on the front end, and the other is going to leave assets to the charity on the back end. And really what you're getting in the year of the contribution is whatever the present value of either that income stream or the remainder interest is going to represent what is available for you to deduct in the year you give the gift.
Yes. And then future, either growth or income from that asset is no longer in your estate. Correct?
Yes. And then the charitable remainder trust strategy, this is the one where it's actually the beneficiaries of that charitable remainder trust, weirdly enough, can be children. Quite often it's children or people who are not going to be in your estate. That you donate generally it's highly appreciated property. You would drop that down into a charitable remainder trust, and then you're going to have income streams being paid out to beneficiaries. It's very rare for that to be paid back into the estate, although that has happened, particularly if you need the income. And you're going to get a gift based on the present value of what's called the remainder interest, or what the IRS will determine is going to be left in the trust, and they're going to discount that at a interest rate. I think it's like a Section 7502 rate, if my memory serves me properly, though don't quote me on that. Anyway, one of the hangups that you might want to consider here is once those assets are in the trust, you cede control of the assets.
Yes.
And that income stream that is being paid to the beneficiaries is not tax-free.
Yeah.
That's another hangup that a lot of people, that's a mistake that some people might make. They're saying, hey, I've donated this money, it's a charity now, so the income coming off of it must be tax-free. No, the income coming out of that trust retains its character. And what I mean by that is if there's interest income in the trust and that's paid out, ordinary income. Capital gains realized in the trust, paid out to beneficiaries, capital gain income.
Yeah. So these are both trusts of the irrevocable variety.
Yes.
Okay. So that's one thing that's kind of important to think about when you're, a revocable trust where, you just a grantor trust that you have while you're alive. You've got a lot of flexibility and, you can continue to pay the taxes. It's essentially you as you go forward. These vehicles are kind of their own. They're an entity.
They are. They're a new entity. And you're right, with the grantor trust, I think the mistake a lot of people make is they've set up a trust, but they still have sufficient control over the assets, where the grantor trust in many instances is just a disregarded entity for tax purposes. And that means all of the taxable activity that goes on in the trust generally is not taxed at the trust level. It is taxed back at the grantor's level, hits their 1040. But what that means is those assets in a grantor trust that's not irrevocable remain in the taxable estate of the grantor. And so you got to get that right, which is why the lead into this was you probably need an estate planning attorney if you're going to employ more esoteric strategy.
Yeah, I agree. So let's finish up for today on this is another very common way that people make charitable gifts, and that is in their estate or in their will as bequests. One of the things, and this is something that you can either do by, say, in your will, specifically identifying assets that you want to go to either people or charities. Another thing to think about, and this again goes to my pet project or pet issue, which is that IRA money is just not a particularly efficient thing to inherit if we're
not anymore.
Yeah, if because of the fact that it has to be distributed to a living person beneficiary over the course of a 10-year period, as opposed to a longer stretch provision from before. So one thing to think about is, say you've got 5 or 10% of your assets that you want to go to charities when you pass away. If you have more than 5 or 10% in IRAs, that would probably be the money I would use to go to the charities. Because again, it goes to the charity. It has never been taxed. It's been taxed for many, many years in all likelihood. The charity will not pay tax on it. They will not either capital gains or ordinary income tax, and you're moving it out of your beneficiaries are not going to have to pay the tax on it either.
Yeah, by leaving our IRA assets to a charity, you are essentially dissolving the IRA structure. It's saying, hey, here's some securities. They have a fair market value. It's a huge charitable gift, but there is no more IRA structure. It's just gone. But now, as to when we had the stretch IRA, that IRA structure for some people was actually a real benefit, because you could continue to defer the growth on the assets you inherited from mom and dad or grandma and grandpa, whomever, and you could drip out the growth from that IRA over your life expectancy, which made using those vehicles extremely tax efficient. With the change to the tax code and this now at least as rapidly as rule, Congress always gives us a mouthful, which will begin in earnest in 2025. Not only will your heirs have to empty the accounts in their entirety in 10 years, they will have an annual mandatory distribution, and Congress can be clever. They know actuarially that people who are going to be inheriting IRAs are probably right in their peak earnings years.
Yeah. So that IRAs, again, just not the greatest of inheritance items. The one caveat there, and this is something that, again, I've also kind of talked to estate planning attorneys about, is not charitable, but say you get to the point where you want to give some money to, say, a non-spouse that, or like, say, a sister or a brother that is not wealthy, just does not have a lot of money to their name. If you want to give them some money, IRA is probably a great choice for them, because that taxation over the course of, say, 10 years, if they were to receive a few $100,000 as an example, they meet that out over 10 years and they're paying maybe 12 to 22% tax rates on it, versus you give it to somebody who already has a big income and it's just stacking on top of that.
Yeah.
So IRA money, great in your estate as a charitable item, also great for lower income beneficiaries.
Yeah, absolutely. And yeah, so I think that part of charitable giving as bequests is identifying to whom the assets should go and who can inherit those assets most efficiently. And as it stands today, the step up in cost basis for after-tax assets, so highly appreciated assets that are outside of an IRA, is still available. And for, human beneficiaries, flesh and blood, human beneficiaries, children, that makes inheriting those assets extremely attractive, because you get a big step up in cost basis at the passing of mom and dad. Not a great event, but now you don't have to pay you don't have to pay any capital gains tax on a hugely appreciated asset.
If any of this was exciting, just remember you have to die to actually achieve it.
Yes. The bequest definitely is a troubling one, for sure. But at life giving, still part of it. So there you go.
Scott, Greg, thank you both for taking the time to walk us through this today. And to all those listening, thank you. To make sure you don't miss any future episodes, you can subscribe to the Baird Retirement Management Show wherever you get your podcasts. This broadcast contains the current opinions of the hosts and are subject to change. The broadcast is provided for informational purposes only and should not be considered investment advice or recommendations. Investors should obtain professional advice before making investment decisions. This is not a complete analysis of every material fact regarding any company, industry, or security. The information has been obtained from sources we consider to be reliable but cannot guarantee their accuracy. For more information about any companies discussed, please contact Baird. Past performance is not indicative of future results, and diversification does not ensure a profit or protect against loss. All investments carry some level of risk, including loss of principal. An investment cannot be made directly in an index. This broadcast may not be reproduced without express permission of Robert W. Baird & Co., Incorporated.